Pfizer crushed on May 3rd. Their revenue jumped up 77% from the same quarter. Now keep in mind, guys, what was the reason? COVID. How important was that? This is their press release. 77% revenue jump, right? Let's go down here. This is their revenue breakdown. The revenue went up from $14 billion to $25 billion. That's an $11 billion gain. Guys, look at their vaccines. 4.8 to 14.9. That is 10.1 billion of that. So they only had $900 million in growth outside of vaccines. To me, this is an important part of analyzing Pfizer. Just like if a company was shut down completely, like Carnival Cruise Line or the airlines, would you punish them permanently because their revenue was down 99%? Absolutely not. So you can't give Pfizer a permanent increase for a vaccine that's probably going to be around for a while, but probably not going to be doing the same thing it did before. Vaccines were the everything discussion, but Pfizer, Moderna, companies were booming and busting based on could they get the vaccine out in time. You have to be smart. Think about it like a business person. If I were to come offer you a company today that sold anything having to do with masks, would you go pay the last 2 years of profit, base your profit on your buy a price based on the last 2 years? Of course not. We don't even wear masks anymore. We don't even wear masks anymore. We went from everybody wore masks to no masks anymore, right? So the same thing here with vaccines. 90% of their growth came from vaccines. And the vaccines, I'm sure if you broke it down, is probably somewhere where it's not going to be good. It's probably going to drop significantly. And a big chunk of it was probably COVID. So let's go look at Pfizer from an 8 pillars perspective to see how it looks and evaluate the company. So we go to our 8 pillar software, type in Pfizer. Pfizer is a $287 billion company. 5-year chart. This was the COVID crash right here. It got as low as, how low did it get? 20 some dollars a share. And now it's at 51, but at a high of 61 as of late last year. All right, so it did well. Again, though, how much of it was from COVID? That's the thing I'm going to repeat till I'm blue in the face. So first pillar, we want the 5-year PE to be under 22.5. It's 17. Check mark there. Pillar number 2, we want the 5-year return on invested capital greater than 9%. It is 12.4%. What fell in that time? COVID. Pillar number 3, we want revenue growth over the last 5 years. Look at this, guys. 52 billion, 92 billion. Guys, look at these numbers over the last 10 years. 53, 50, 49, 51, 52, 52, 41, 38, 46, $92 billion. It doubled in 1 year on a company that went nowhere for 10 years. And there's a story behind why that is. It was COVID. So if I'm an investor, my immediate reaction is I strike this whole year out. I'm not even going to look at last year. You might think I'm crazy, but I look at it going, guys, this is not the future of Pfizer. Does Pfizer have nice potential as a reliable source for vaccines? Absolutely. It's been proven because of COVID. But you got to factor it in on even this one includes COVID times. I just look at this saying, you've got to be cautious going forward with Pfizer because the story all centers around COVID. And we'd probably all agree that even if COVID makes another surge, even if that happens, it's not going to be a permanent surge. We're not going to have this permanently. We're not going to have COVID vaccines needed permanently at the levels we had them before. It's just not a reality. Pillar number 4, we want to see net income growth the last 5 years. Can anyone guess what's happened in the last 5 years? Actually, they had a big year that year, 21 billion to 25 billion. They probably sold something here. Pillar number 5, we want shares outstanding decreasing. This is a silent killer for investing. What ends up happening is companies that sell it for high valuations will issue shares instead of issuing debt. Because it's cheaper to issue shares at high values than it is to have debt. So they issue shares. The problem for investors is you're now getting a smaller and smaller piece of the pie. You're getting diluted. Companies that buy back shares are giving you a bigger piece of the pie, but it's important they buy back shares at good valuations for the company. So we go to the bottom of the income statement. We look back at the end of 6 years, 6 billion shares outstanding. Last year, 5.62. Check mark there. All right. Pillar number 6 has to do with long-term liabilities. So debt is an important aspect of every business, and we want to make sure businesses can support their debt. So we go back to the main page here. we look at their 5-year average free cash flow, $17 billion. We multiply that by 5, $85 billion. We want their long-term liabilities under $85 billion. So we go to the balance sheet in our software. We scroll almost all the way to the bottom. Total long-term liabilities, $61.9 billion. That's a check mark. We want it under 85. So we're good there. Now, our final two metrics are free cash flow. Now remember, guys, free cash flow is the lifeblood of the business. Free cash flow is cash from operations less your capital expenditures. There are 5 things you can do with free cash flow. Buy back shares, pay down debt, make acquisitions, invest back in yourself, and pay dividends. You can do 1, all 5, 2 of them, doesn't matter. You can do none of them. The point is, there are 5 things you can do with free cash flow. We make it easy for you. Free cash flow is not put on the cash flow statement. We added it here in our software. 14.9 billion 5 years ago, 31.7 last year. Check mark there. And our final metric, we want to determine, like a PE, we want to price the free cash flow, a value based on the free cash flow. So we take the 5-year average free cash flow of 17 billion, multiply it by 22.5. So that's 340, 34, 374, and 8, $380 billion, roughly. Let's see if my math was anywhere close to correct. So we go to the calculator. We pick 17 times 22.5. Oh! $382 billion. And if you guys remember, the market cap was $287 billion. So this says check mark. So there's a lot of math I did here, but we have the 8 pillars tab that does it all for you. It is an 8-pillar thriller. It has all 8 check marks. Does that mean you go out and buy it? No. This is a screening process. This tells you a story. The story it told me, based on looking at the income number jumps and all that stuff, is COVID. Be cautious because of COVID. I want to be very apprehensive because of COVID. Revenue is probably going to fall, is my guess, but that's going to take listening to earnings calls, other things to have a conversation. Go in our community. Have the conversation in our community about what's going on in Pfizer. What do people see? What are people reading? There are over 6,000 people here you can talk to about that. So to determine what to pay for Pfizer, we're going to use a stock analyzer tool. This has been one of the most important aspects of our software because every investment is the present value of all future cash flow. We don't know the future. If we knew 100% the future, it'd be very easy. Just what's the profit going to be in the next 10 years? Bring it back to today based on your desired return, and that's what you pay for the company. But we don't know it. That's the art of investing. So we make assumptions, low, middle, and high, to determine a roundabout place of where we want to look, and the price is below any of these levels, it warrants looking further into the company. So let's go do this. 10-year analysis. Guys, their revenue growth last year was 100%. The revenue growth in the last 10 years was 6%, and that included 100%. Guys, I'm going to go -5, 0, and actually I'm going to go, -5, -2, and 1% revenue growth. Profit margin, I'm going to do 20, 22, and 24, 20, 22, and 24. PE, I'm going to go with 10, 13, and 16. And guys, my desired return, I'm actually going to do 15% here. So if you're watching this and saying, oh my God, this guy's being too conservative, I know. Because to me, I don't know how this company's going to do in the next 10 years. I've got to be very conservative. And I want this price that pops up to be so much higher than this that it makes me want to do more research. So we hit the analyze button. Guys, here's the problem we have. They're reds all around. A low of 17, a high of 37. But hear me out here before you go. Let me explain something to you. Here's how scary it is. Assuming COVID revenue stays the same and it still grows 1% per year from here. So that means Pfizer never has a drop in revenue. It's still overpriced based on these assumptions for the future. And that's what I want you to pay attention to. So I'm going to add this to my watch list under 25, notify me, and I'll go back and take a look at this when it falls in half. Thank you very much.